Hi, welcome to another Coffee Time Chat. Today we're joined by Dr. Don from Strategic Solution Partners, one of our expert partners. As is customary when we have Dr. Don join us, we love to delve into his wealth of knowledge and financial expertise to hear his views on the current state of the hotel industry. His track record speaks for itself, and keeping his fingers closely on the pulse, he is well placed to assess the health of the sector. The heart still seems to be beating strongly with continuing demand, but will this carry on or melt away? Let's find out. Really hope you enjoy the conversation. Hey, Dr. Don, good to see you again. Thanks for joining us. I always enjoy these conversations. But before we get started, how are things with you? You well?
Yes, thank you so much. Yes, we finally got some sun here in Southern California. We didn't have
Finally,
any
it's
sun.
always sunny in California.
No, I gotta tell you, May and June were pretty June gloomy. We finally got sun in July, and knock on wood, we're supposed to have a little bit of rain this weekend. Wouldn't count on it. Our weather forecasting this country is not a science; it's art.
I think that
So
seems to
we're
be
getting there.
everywhere. It seems to be everywhere at the
I
moment. Predicting the weather is seems to be quite challenging. Um, but you tend to come on and we have these conversations and you kind of give us a bit of an insight into where you see the market is. So maybe at the end of this you'll be able to give us some predictions as to where you think it might be going.
Well,
But
I thought we'd start with a kind of some scripted notes because this is a lot to digest. I'm not an actor. I would be a lousy actor. I got a B in biology, Trevor, because I couldn't memorize. I was 4.0 in biochemistry and organic chemistry and everything biology because I couldn't memorize. So
hey, no
pardon
worries.
me for having pardon me for having to read and not be a Michael Caine and be able to just
I
digest
appreciate
all
you
of this.
taking the time to even do the research and prepare for it. So you fire away. Where do you want to start? I know we're going to look at cap rates, operations, interest
Yeah,
rates. Where do you want to go with?
let's keep it simple.
Hmm.
Um, let's be honest. We live in a very complicated world right now. Inflation in the United States just raised from 3.2% in July to 3.7% in August, and gas prices in California are now unbelievably about $7 when they used to be closer to three. And we're saying, is the Fed going to settle for inflation rate of 2.5% to keep us from going into recession,
Hmm.
or are they going to keep on going with that mantra of 2%, and then pretty good odds that we're going to be in recession in this country anyway.
Right.
And then you've got things that are going against the tide. Hyatt Hotels forward booking for business transient leisure travel in New York in October outpaced 2019 by 20%. And the company's CEO says that Bill Gates is wrong about his well-known comment back in 2020 that all business travel would be down by 50% permanently.
Hmm.
And then you've got what's going on internationally. Let's not talk about Ukraine and other, but look at China.
Yep.
Chinese developer Evergrande with $300 billion of debt stopped trading on the stopped trading on the Hong Kong Stock Exchange this morning. Apparently, Evergrande is not so. We just had several lodging conferences this last month. 83% of Lodging Industry Investment Council members surveyed this month predicted that hotel capitalization rates are rising. And the capital markets are disjointed. Cost of financing is high. We're in the eights on financing and tens and twelves on construction debt sometimes.
Hmm.
There's a realization and a reconciliation and rationalization that things must change and buyers and sellers are going to get closer together. The delta between bid and ask on sales is going to get closer together. So with some realization and all these things, we should see more transactional activity in 2024.
Okay. That makes
And there's
sense. I mean,
definitely
investors don't want to be sitting on their money, do they? I mean, they want to be they need to put it to work. So I mean, there's got to be a meeting of minds somewhere, hasn't there?
there absolutely has to be. And I was trained, as you may call, very institutionally, 2 summers with Steve Rushmore at Cornell at Hotel School. Steve, of course, is the intergalactic guru on hotel appraisal and feasibility.
Mm-hmm.
And Steve taught us several things. First of all, he said the most important thing when buying or building a hotel is barriers to entry. You don't want a new 400-room Marriott coming in right next to
Yeah.
you. The other thing is you have to be realistic that these are operating businesses. They're real estate, but they're operating businesses. And you just don't stick a shovel in the ground to build a new hotel unless you're at least a 20 to 22% IRR.
Mm-hmm.
And the equity out there looking to invest, stressed another, they're probably looking for probably a 15% plus IRR.
Yeah.
So these are numbers that don't move. They're kind of like debt coverage ratios. I've spoken to appraiser groups for many years. Debt coverage ratios on hotels historically been 1.4. That probably hasn't moved in 40 years. So, some of these numbers, they are what they are, and if the property or the owner can't accept that, then they are choices. You're going to have to go out to friends and family for equity.
Mm-hmm.
You're going to have to go out to institutional, sort of high net worth or other preferred equity. And in some cases, they're going to have to sell. In some cases, regrettably, they're going to have to turn the keys back.
Yeah. Well, we've seen stories of that, haven't we?
Happening. It's absolutely happening. I was just I was going to comment on I think I haven't got there yet. I made a comment that according to Moody's, 9 of the 19 CMBS loans that have been liquidated in the second quarter of 2023, 47% were hotel loans. Those are hotels that initially defaulted in 2020. They've tried since 2020 to get their legs and get back on the ground and get positive. Every single one of those hotels sold at loss after the borrower failed to work out the solution and avoid a default.
Wow.
So that's not a very big number, but as interest rates remain high, it certainly portends the future.
Yeah. No, it's certainly a chat. I mean, you know this area way more than I would even have a clue. I haven't been involved in investment or financing or anything like this. What do you?
I was going to say that's why you have all your hair, but I can't say that with you, Trevor.
No, I just grow it around my chin. Yeah, I'm obviously in the wrong business.
That's my usual line. It's one of my best lines, and I can't use it with you.
You can't use it with me. So, what do you? I mean, just looking at the cap rates. I mean, you said. What you said, according to Reuters, hotel owners could see greater pressure on their ability to service the loans back in their properties. I mean, if we're looking at that overall picture, what do you see as the short, medium, and longer term implications of this current situation?
Well, short term is a bit of a wild card.
Mm-hmm.
The problem with recessions is it's as much, frankly, perception sometimes as it is reality.
Yeah, good point.
And so much talk about recession that people don't know what to think.
It almost
we're
becomes
already
a self-fulfilling prophecy, doesn't it?
it absolutely positively. You just nailed it. You just nailed it, Trevor. Now, there's a lot of things that we've talked about before going on, which are no surprise. Although with increased staffing, our grades from some of the rating agencies are improving as far as customer satisfaction. With that being said, I just saw, and I didn't scramble to get it. I should have. It was just a survey that came out. That can't be more than 5 or 6 weeks ago, prior to this terrible fire disaster in Maui,
Mm-hmm.
that 55% of travelers to Hawaii said they would not go back to Hawaii for 5 years because it was just too expensive.
Right.
And we talked about this before. Pushback, you raise rates, you do this, you do that. Well, it gets to a point where people just say, "Hey, that's just, that you're pushing my budget," sort of thing.
Mm-hmm.
I mean, I've heard stories where a family of 4, it cost them, $6,000 to go to Disneyland for 2 or 3 days. I mean,
jeez.
Yeah, these are just. I mean, this is reality here. I mean, we have pocketbooks. Nobody as a cash flow
Yeah.
uh, to do some of these things. So we're definitely getting a push pull, and then we've got our insurance costs, which would be between hurricanes and wildfires in California now. This terrible situation in Lahaina that could be billions of dollars. We're seeing insurance costs for hotel owners going up 2 to 3 times in areas that have any chaos involved,
Wow.
historic chaos, on top of all of our labor issues, which we've
Yeah.
all talked about
Yeah.
ad nauseum, et cetera, et cetera. So there's just so many things pulling in so many different directions. It's it's challenging. It's
S-
just you got to be real time. There's no time. There's no time to sleep right now.
So,
We've got to be on our game 24/7, 365. Otherwise, we find our potential selves potentially in harm's way, frankly.
so from an operational point of view, I mean, you've spoken there about starting to see a resistance to the higher rates.
Mhm.
You've touched on the defaulting on loans and some of the impact there. You've spoken about the increase in insurance rates. I mean, what other factors are we seeing? Are we starting to see a decline around a shift in the business from leisure business? I mean, you spoke earlier about group business coming back against the predictions of some people. Are you seeing a shift in the way things are operating?
Absolutely. I just that was coming up in my prepared notes.
Uh huh.
According to Fitch Ratings, as a surge in travel after the pandemic wears off, demand is shifting away from pricey leisure stay for business travel.
So I just lost that last bit. I heard you say away from the pricey leisure stays, but and where's it
Correct.
shifting towards?
Towards the lower rated business travel,
Right. Okay.
a group and a transient leisure business travel. So
Interesting.
instead of the $400 a night, they're shifting down to the 175 or $200 a night,
Yeah. Yeah.
hotel
Yeah.
for their experience.
Interesting.
So it's right there. I don't, and that was real time. That was a comment by Fitch in the last 2 weeks probably.
Right.
So yeah, it's definitely a trend. Definitely a
Definitely
trend.
seeing a shift. So I mean that's so then I mean the implications of that, um, the slowing leisure demand. I mean we could all extrapolate out, but I mean what are the obvious what are the obvious factors that are going to occur from that demand starting to drop off?
Well, I think you're going to see, in most markets, ADR seems to be hanging in there,
Hmm.
but occupancy overall is definitely falling off.
Yeah.
And some of it is for reasons that you might not think about. I just heard I was on a call yesterday on a kind of an interest high end almond sort of thing in Northwest, and the comment was that in one of the wonderful Braemar resorts in California, that uh, they have projected for 2024 a 4% lower occupancy rate just because they can't get the employees that can deliver the level of service that they need to keep the property operating at the higher occupancy level. So
Interesting.
there's a situation where it's not the market. It goes back to these same labor issues that we've all been belaboring since the pandemic.
Yeah.
If you remember back about, it must have been the late 80s, I had the pleasure of getting to know and work with Horst Schulze, who was the president of Ritz Carlton at that time. And I'm a huge French Polynesia fan. I've been going to World since probably 1985.
Hmm.
Love French Polynesia. And I asked in French Polynesia, would you like to do a resort there? And, oh, that kind of went, oh, okay. And he said, I could never get from the Polynesian people the level of service as servers to deliver at the 5-star Ritz Carlton level. So, I mean,
Right.
there's all kinds of different reasons of why things happen, but occupancy is definitely softening because of what we just talked about. People are going to say, "Hey, I few less days.
Yeah.
I'm going to stay a little less expensive hotel that fits within my budget." or we have labor issues, which in different ways kind of, meld their way into the whole equation of some of our operational issues running these wonderful.
So if we strip out for a moment the staffing issues, because you say that's a short, medium, and long term challenge. But if we're starting to see a shift in the leisure market, or certainly away from the pricier leisure um, stays, are we going to see pressure be brought to bear on actually the pricing? Will we see those properties that in that post-pandemic, that desire of everyone to go out and travel and suddenly just find a way of spending $500, whereas previously it was $350 a night? Will we see a point at where those resorts, those properties, are just going to have to start bringing the prices back down, and we're going to see a drop in that revenue growth and in the ADR?
Well, the answer is I hope not, and it's not probably the reason that you think. Um, Again, I was schooled very traditionally by Rushmore at Cornell, and we always said that you keep your ADR and you sacrifice occupancy, because when you sacrifice occupancy, by definition, that means your property is being beat up less. You don't have as many suitcases going down the hall that miss the corner and scratch the corner or scratch the elevator or do this and do that.
Mm-hmm.
And if you drop the rate, it's hard to get back.
Mm-hmm.
People have very long memories
Yeah.
as far as rate, and you start getting in the rate war, and now you've lost your competitive advantage. I've always said if your only competitive advantage is dropping rate, then you have no competitive
Yeah.
advantage.
Yeah. Yeah. Yeah.
Got to be You've got to be a leader, and you've got to keep the rate and sacrifice occupancy, because if you drop that ADR, you're going to fight to get it back.
Yeah.
You're just going to fight to get it back. In a great economy, maybe not, but in an enormous economy, you're going to just fight like heck to get it back, and that's very painful. And when you have the lower occupancy, guess what? You're not beating up your hotel as much.
Yeah.
It makes sense. It's very logical.
But yeah, I mean, I still you still see a squeeze, though, isn't it? Because
Oh, it's a squeeze, absolutely.
if our costs are going up, even if we're bringing our occupancy down but keeping our rate, what the actual revenue we're generating is going to be less. So
Well, but again, Trevor, this is why, and I'm an old fart, so I mean, people never listen to me, but once in a while, I hope they do. I've told clients for nearly 40 years, don't put more than 50% debt on a hotel.
mm-hmm.
You have 50% debt, 50% equity. You're going to probably weather any storm. You probably would have weathered the RTC debacle.
Mm-hmm.
You probably would have weathered the terrible, terrible events after 9/11. You probably would have weathered the Great Recession from 2007 to 2010.
Mm-hmm.
You probably would have, weathered the pandemic, because debt is a four-letter word.
Just if it's over
And
leveraged.
it'll get you.
Yeah.
And the lenders are like the IRS; they have no sense of humor.
And I guess that feeds into, I mean, one of the other points that you'd highlighted that you were doing some research around was with regards to interest rates. Um, I mean, what's going on over there? Because I mean, we've been in the UK, we've been steadily going up. We seem to have plateaued a little bit, from a household perspective. There's been a lot of pressure on mortgage payments, and those rates are starting to stabilize. But what's happening in the US? How is it playing out from a commercial standpoint, the area that you're very much involved with?
Well, I mean, you see the pressure everywhere. I get, like everyone, way too many emails a day. And I got an email yesterday from Wells Fargo. Their good guy jumbo rate for borrowers to buy a single family home is 6.75%. When that rate was probably, let's just guess, 3% plus or minus, 24 months ago. Um, with our developer clients, we're trying to use a lot of CPACE, which may not be a term familiar to you. There's no reason why it would, but it's basically a form of financing which finances pretty much anything environmental, whether
Okay.
it's solar panels or light bulbs or various things that are considered environmental.
Hmm.
And on a large project, $100 million, $100+ million project, you might be able to get as much as 25 or 30% of the CPACE financing, which is typically 30-year. It's pretty favorable, but it's typically in the 7.5 to 7.5% range.
Okay.
Well, that softens the blow of your construction loan at 12% because your effective rate is getting down, pretty
Yeah, you're
close to
bringing
maybe
it. Yeah, yeah,
10 plus or minus. You got,
yeah.
you know, $70 million at 12%. You've got $35 million at 7.25%. You work the math. The blend is somewhere in the tens. So that's been helpful. But the other challenge there is that many lenders will not accept CPACE, and now we're starting to see some softening there.
Yeah. Hmm.
But that's challenging. The other thing that's frankly has been just very hard on us is inflation.
Yeah.
We have projects, we have several projects. They were $100 million construction cost in in January of 2022.
Oh, I dread
By
to think what they
July
are now.
2022, they were up $12 million.
Wow.
So now, not only has our IRR taken a huge hit,
Uh-huh.
we've got a $12 million shortfall in our cap stack.
Yeah.
The lender is not, lender may go up a little bit, but they're not going to go up the whole thing. So now the developer or borrower's got to figure out where that equity is going to come from to bridge that. So, the combination of these construction costs with higher cost of debt it's been very challenging.
And
Very
what's
challenging.
what's the Fed doing at the moment? Are they raising rates? Are they low? I mean, they went up
No,
recently,
I
or
mean, give you an example, that Wells Fargo loan I just talked about was 6.25% a week
hmm
ago. Now
right,
it's 6.75.
right,
So yes, rates, what we acknowledged, the stock market acknowledged right after the Fed announced they were not going to bump in September, was that everyone has accepted it's going to last longer scenario.
right. Okay.
They're saying that we really won't see any significant rate reduction. These are the pundits, not Don,
Hmm.
until 2020.
Right.
So it's going to be with us a while.
And how are the markets responding to that? I mean, are they following it? Are they pricing it differently? I mean, what do they
I think
see?
I think they have. I didn't watch. Oh, actually, I did watch. But take a peek this morning. The market was up a little bit this morning. But I mean, the stock market is such a strange indicator. I mean, as you know, it flip flops on the deck like an albacore you just landed. I mean, it's pretty crazy. But I think it's settling down a little bit. Um, Most people I know do not think the Fed's going to push it. All of this, as I business together, that I bought a new crystal ball from Amazon, and it's not working very well. You know, um, we've all been wrong, and we're going to be wrong many times more. But hopefully, we're going to see a pause in the interest rates, and at some point in time, actually start seeing them come back again. But
I've lost you there.
it's
I've lost you.
too many wild cards in the middle of this election stuff going on in the United States, and what's going on in Ukraine and North Korea and Putin. And I mean, as I mentioned earlier, this is a very complicated world right now.
Mm. Is anyone talking recession?
Oh, everyone is. That's the problem.
But
That's the
is it?
problem. And
But I mean, back to your point, are we? Are
yeah.
we? Is does the data support the likelihood, or is it the narrative and the commentators talking the recession up?
Well, I know. I mean, and that was another one of my talking points. Another thing, a recent quote from Fitch. They anticipate a mild recession the first 6 months of 2024.
Hmm.
Signed, but they said that would likely weaken leisure travel demand even further.
Right.
He didn't give a number, but I mean, again, if you're looking at down arrows and up arrows, that most of them, right now are going that direction.
And we've spoken before when we've spoken on these discussions when we've chatted offline um, at all the headwinds seem higher interest rates, cost of living crisis, the Ukraine scenario, interest rates, labor shortage, everything seems to be challenging for the hotel sector. Yet we've always had this continual rates going up, occupancy holding up. I mean, how how does it buck the trend, or are we at a point where maybe that tipping point has been reached, and next year could be slightly more challenging? What is your dodgy crystal ball that maybe hasn't been working? What might it be saying?
Well, all I can tell you is I'm glad I'm old. I've tolerated this that much longer. I'm just, um, the hotel business has always got challenges.
Hmm.
Um, you can't you can't be timid and be a hotelier.
Right.
Whether you own a 20 room Motel 6 in Kansas, or you own the new $1 billion, what was it? Someone just told me there's a new $1 billion uh, hotel that just opened in London. It just
Oh,
opened, I guess, this last week.
yeah, yeah, yeah.
No matter how you cut it, it's a risky business, and
Yeah.
that's why our returns have to be what they are.
Hmm.
That's why that PE has to be north of 15% to get out of bed. They're
Hmm.
just not going to do it's too much risk. That's why our construction IRRs on Libra deal have got to be 20 to 22. There's just, I mean, it's like, what's the risk du jour?
Yeah.
And I said earlier, you've got to be, your game focused, sober focused, 24/7, 365.
and and don't.
Next year, we hopefully it'll settle down. Hopefully rates will start going the other direction. But then what are we going to have? We're going to have another, knows what? I don't want to opine something and be
No, no, no.
cast a shadow. But I mean, it's the real world. It's just what we do, and it's been a good. We all enjoy it. We love it. We love the relationships.
Mm.
I've said for many many years that I've stayed in the hotel business because I love it. It hasn't always loved me. I can assure you, after the terrible events in this country of 9/11,
Yeah.
all the only industry hurt worse than the hotels after 9/11 were the airlines.
Yeah.
Uh, but it's it is a business. It's not a bond. It's not you're not buying a corner in Beverly Hills with a Chase Bank on it that's going to pay you a 4% with a bump every year, every month for 15 years.
Hmm.
That's a nice bond.
Yeah.
Hotels are almost not exactly, but pretty much the opposite of that. There's
That
risk,
makes.
and that's what it is. That's part of the game. And as I've said, a webinar thing also previous not thing event earlier or previously. As my dear friend Mark Rousseau told me many many years ago. Mark was a senior Holiday Inn. That the hotel business is like a screen door. All the flies on the outside want in, all the flies on the inside want out. That's the hotel business in a nutshell, Trevor.
Just from the world that you live in, where you're working with hotels around financing or looking at deals coming across your desk, are there particular sectors that are just holding up well? But maybe you don't want to. Maybe you don't want to share where where
Oh
the
no,
where
no,
the where the
absolutely.
where the where the areas are. But I mean, are there
No,
particular sectors, particular types of
well, absolutely.
properties which are really that are the ones to look
No,
out?
oh, absolutely. I mean, everybody wants to be in the select service business.
Right.
Everyone wants to, have a nice branded, smaller hotel without food and beverage. You can run it with a staff of 4 or 5.
Mm-hmm.
Simple, simple, simple.
Yep.
That's the select service. I mean, KSL, who historically, has owned wonderful, wonderful La Costa, and huge, wonderful golf resort in San Diego.
Mm-hmm.
The Now the Omni Mauna Lucia in Paradise Valley,
Mm-hmm.
wonderful resorts. I still think they at one time, I think I'm not sure they still own the Waldorf Astoria in Maui. They've created a whole division just buying select service hotels.
Really.
That's definitely where the action is, and um, so yes, there's absolutely the extended stay product
Mm-hmm.
in the right market still makes a heck of a lot of sense. I mean, I was privileged enough to spend time in the car with Jack DeBoer, the founder of Residence Inn Company, back in the 80s.
Mm-hmm.
We looked at sites together when I was doing site work with Residence Inn. Still a great business model. The Embassy Suites that was Bob Lilly and other that created, still a good business model in the right market for a suite property. Women travelers love it.
Mm-hmm.
Interior quarters, open, safe. It's very, very comfortable for a woman traveler in an Embassy Suites the way they used to be and are still currently designed. So yeah, the several products that make sense, but clearly the select service, good revenue, inexpensive to build, run it simple, simple, simple. As we get forward, it's going to be more simple. AI is going to become an increasing thing. So many hotels now are totally touchless. So you just check in and you do this, you do that, and you that button, and you wave this, and a machine spits out your key card, and you're off, et cetera, et cetera. So the select service is the perfect to accept that side of more touchless sort of hotel experience on a go forward basis.
Yeah.
Sort of the riddle, Trevor.
No, it makes a lot of sense. And do you see? I mean, I know that the US is different in the sense to Europe with higher prevalence of branded properties, chain groups, as opposed to independents. But I mean, is there an increasing divide even in the US now, where it's all about branded properties and there's less? I would think it would become more challenging if you were looking to set up as a independent hotel. You've got to have a pretty unique offering to be able to stand out, and maybe that comes with increased service and therefore increased costs. So maybe the business case around it becomes more challenging. Or can you talk to a different side of that argument?
Well, that's kind of it's kind of a bipolar discussion.
Yeah.
On one end, if you want to get a hotel financed,
Mm-hmm.
built, financed, refinanced, it's really got to be one of the four. It's got to be Marriott, Hilton, Hyatt, or IHG.
Right.
And I don't want to be discriminatory, but if you're a Radisson choice product, you're going to be a couple clicks down from the standpoint of getting financing. That's just a very, very real.
Sorry, what were the other one? I heard choice. What were the other ones? You just clicked. You just
well,
dropped off.
Radisson, Wyndham, Radisson. I mean, Wyndham.
Just
Western.
like a level down.
Yeah, it's just it's kind of the A team and the B team.
Yeah.
A team, it's not guaranteed, but a heck of a lot easier. B team, again,
There'll be some questions.
You're up against it. From the standpoint of the experience, I think that independents have a tremendous opportunity.
Mm-hmm.
One is looking for this experiential sort of experience. That's a kind of a redundant.
No.
Experiential venue. When we're told that young people choose their hotel based on how Instagrammable it is.
Yep.
What's it going to look like when they stick their phone up and go like this and Cabo or whatever? They're picking a hotel for that reason. I mean, go figure. I mean, that's for you and I. That's
a different, we're a different world. Yeah.
But independents do. That's an opportunity.
Yeah, absolutely.
Opportunity to appeal to a different demographic and to create something cool. You get to go ride on an elephant or a buffalo or whatever the local thing is that is different and is one of a kind, et cetera.
Yeah.
So, and it's can definitely keep up there. Plus, they haven't got a brand looking over their shoulder.
Yeah.
They can be a little more creative. They can certainly be more responsive. They can
more nimble. Yeah.
All those things on the off side, but on the finance side,
they just got to be able to fund it, haven't they?
This real world over here, it's tough. It doesn't, again, it's like the IRS, no sense of humor.
Yeah. And no more than 50%. Brilliant. Always a pleasure talking with you. I'm conscious of your time, so I don't want to overstay our welcome. But thanks so much for joining us today.
Thank you so much, Trevor. Very, very much.
Take care.
Bye-bye.
Well, I hope that conversation was of interest, and thanks again to Dr. John for joining us. If you have any thoughts or views on this conversation, please feel free to comment below. If you like the discussion, please don't forget a thumbs up. And if you're interested in more of our videos, here is a link to our Expert Insights playlist, and here is the link to our Coffee Time Chat playlist. And here is the button if you'd like to subscribe so you don't miss out on future videos. Thanks again for watching.